Hey everyone, welcome. Today we are going to break down one of the most popular tools in any trader's toolkit, the Relative Strength Index, or RSI. We'll see how this indicator can help you cut through all that market noise and get a much clearer picture of what's really going on with momentum.
You know, trading isn't just about numbers and charts. It's a huge psychological battle. The market is really driven by two powerful emotions, fear and greed. And that creates this chaotic roller coaster that can totally throw off even the best laid plans.
So the big question is, with all that emotion driving the price up and down, how in the world do you find a clear, objective signal in all that chaos?
And that's exactly where technical indicators come into play. They're designed to help us get off that emotional roller coaster. They take the guesswork out of it and give us a more rational, data-driven way to look at the market.
Now, one of the heavy hitters in this space is the Relative Strength Index. At its heart, the RSI is a momentum indicator. Its whole job is to tell you when a stock or an asset might be overbought, too many buyers, or oversold, too many sellers. It gives you a heads up that the trend might be about to change direction.
Okay, so how does this thing actually work? Let's decode the RSI and figure out what these terms overbought and oversold really mean for us as traders.
Basically, the RSI works on a really simple scale that goes from 0 to 100. What it's doing is calculating how fast and how much the price has been changing recently. This helps us figure out if something is getting a little too expensive or maybe a little too cheap at its current price.
So the classic rule of thumb is pretty simple. When the RSI gets above 70, we call that overbought. It suggests that the buyers have been going wild and the price might be getting stretched, maybe it's due for a pullback. On the flip side, if the RSI drops below 30, that's oversold. That's a sign of heavy selling, which could mean the asset is now a bargain and might be ready to bounce back.
But, and this is super important, those standard 70 and 30 levels aren't some kind of magic formula. The market is always changing and we need to be flexible and adapt our tools to match it.
Just think about it for a second. In a really strong bull market, a stock can stay overbought for weeks or even months, while the price just keeps climbing higher and higher. If you sold just because the RSI crossed 70, you'd miss out on a ton of profit. So yeah, those standard levels can give you a lot of false alarms in a trending market.
So, the secret is to adapt your strategy. If the market is just chopping sideways in a range, the classic 70-30 levels work great. But if you're in a strong uptrend, you might want to adjust your levels to something like 80 and 40. By raising the overbought line to 80, you filter out all those early sell signals. And in a strong downtrend, using 60 and 20 can help you stay with the trend. It's all about tuning the indicator to match what the market is actually doing.
All right, you've got the basics down. Now, let's level up and talk about a more advanced and, frankly, a much more powerful idea: RSI divergence. This is where we learn to read between the lines on the chart.
So, divergence is basically when the price and the RSI start telling you two completely different stories. The price might be making a new high, but the RSI isn't. This disagreement is a huge clue for traders that the momentum behind the trend is starting to run out of gas.
Let's break down a classic example: bearish divergence. First, you see the price on your chart make a new, higher high. But then you look down at your RSI and you see that it's actually made a lower high. See the disagreement? It means that even though the price went up, the energy behind that move was weaker than before. It's a major warning sign that the uptrend might be in trouble.
And it works the other way around, too, for what we call a bullish divergence. In this case, the price hits a new lower low, but the RSI makes a higher low. This is telling us that, yeah, the sellers were strong enough to push the price down, but their momentum is fading. The selling is drying up, and the market could be getting ready to turn back up.
So, when you really get down to it, divergence is like your early warning system. It gives you a sneak peek into a potential change in the market's direction before it's obvious to everyone else just by looking at the price. That can be a real edge.
But with great power comes great responsibility, right? Let's talk about the absolute golden rule for using the RSI, or really any technical indicator out there.
Look, just because you see a divergence, it does not mean you should immediately mash the buy or sell button. It's a fantastic warning sign, but it is not a command to trade. Acting on an RSI signal all by itself is one of the most common ways traders get into trouble.
So, what do the numbers actually say about this? Well, studies have shown that if you use RSI signals all by themselves, they're accurate about 62% of the time.
I mean, that's better than a coin flip, but we can definitely do better than that, right?
But get this, when you take those same RSI signals and wait for a second indicator to confirm it, like a simple moving average, the accuracy can jump all the way up to 78%. That's a huge leap, and it shows you why confirmation isn't just a nice-to-have, it's an essential part of a solid trading strategy.
Okay, so what are you looking for? How do you confirm a signal? Well, you want to see other evidence that supports your idea. Do you see any powerful candlestick patterns like a bullish engulfing candle? Is your signal going with the bigger overall trend? Is there a big spike in volume to back up the move? Is this happening at a well-known support or resistance level? Every yes you get adds more and more confidence to the trade.
All right, let's wrap this up with the key takeaways. First, RSI is all about measuring momentum to find those overbought and oversold zones. Second, don't get stuck on the 70-30 levels. Be ready to adjust them based on the market trend. Third, divergence is your best friend for getting an early warning about a potential trend change. And finally, the golden rule. Always, always, always look for confirmation before pulling the trigger.
And this brings us full circle right back to where we started. We've got these incredible tools like the RSI to help us be more objective. But even with the best tools in the world, at the end of the day, the person clicking the mouse makes the final call. So I'll leave you with this thought. Is the real challenge the market itself, or is it the trader looking back at you in the mirror?